Alright guys, today we have a little bit of a different video here. We're actually not going to talk about crypto at all today, and we're going to spend this video actually touching on the stock market. As you can see, we're having a look at the Dow Jones Industrial Average here. And what we're going to touch on today is why we normally see a recession every time the Fed actually cuts rates, which I believe is quite relevant as we have a Fed meeting coming up this week, although I do think that they are going to continue to pause rates. I'll show you why cutting rates is actually bad. And then in the second half of this video, I'm going to show you market structures and why I believe we are at the final tipping stage of the Dow Jones here and the stock market, and that the way all of this is setting up is actually pointing to a crash. So lots to cover in today's video. Let's jump into it. So as you can see, we're having a look at the Dow Jones Industrial Average here, which is the Dow, and we have things set on the weekly time frame. So you can see things much higher. We're looking all the way back to the 90s and the 80s back here on the left. And what you can see is that these blue lines I've marked out are actually every time the Fed has cut rates. And we can see that by turning on this tool, which is the Fed funds rate. And every time the Fed funds rate goes down, that is them cutting rates. Up is them increasing rates. Pretty self-explanatory. And what you can see is that we have started the start of a cutting cycle back in July of last year. However, since July, we actually haven't seen any price sell-off. We're actually higher than when we started cutting rates. And I'm going to show you guys why that's happening and the way these things usually play out. Where we're going to start with this is actually back in 2019, just before COVID ended up happening. And what you'll see is if we have a look at this period of time, the rates actually initially were paused out in December of 2018. And then once we actually seen the first rate cut, the market did continue to rally during this time. And you can see if we open this up a bit more, once rates were cut here where this blue line is, market did continue to rally. And then what ended up happening is there was a pausing out period and then a second cut, which ended up bringing the rates all the way down to 0% here. But in this second cut, when we did cut the rates again, we did see COVID and we seen a market crash. And in this instance, the market actually crashed almost 40%. So the most recent time that we have rates actually getting cut was pre-COVID, and it led to a 40% market crash. Now, the second example we're going to have a look at here is the time before that when they cut rates, which was back in 2007. And for anyone around knows exactly what happened in 2008, which was the global financial crisis. However, you can see things actually played out somewhat similar here, where initially we had the first cut, a pause, and then a second rate cut. After the pause and they cut rates for the second time, this was right here on this moment, and then we ended up having a 44% crash after that. However, this time, unlike the last, from the day they cut rates, it almost marked the market top, and we did see the GFC, which was a 54% crash. So the last two times here that the Fed's cut rates, we've seen market crashes. Now, if we go back to the time that the rates were actually cut before that, was in the 2000s. Now, the Dow Jones didn't get as affected as the Nasdaq did back in 2000s when we had the dot-com bubble and the crash. However, the Fed did cut rates right here in October of the year 2000, and from the day the Fed cut rates, we ended up seeing the market pull back 34% all the way until the rates actually bottomed in June of 03. However, another example of the Fed's cutting rates and the market actually crashing. So the last three times now that we've seen rates cut, we've seen market crashes. Now, if we go back to the one that happened before that, what you can see here in 89 is that before the Fed actually cut rates here, there was a previous cut and a lot of confusion as to where the Fed funds rate would actually sit. As you can see, they cut rates, they pumped them back up, they cut them, they pushed them back up. Then they went on this cutting cycle. However, during this time in the 80s and the 90s, the market actually rallied into and through the entire rate cut. However, once the initial rate cut had happened and then they paused rates during this period here, and then we actually seen the final rate cut, which brought it back down to those lower 3% areas, we did see a few corrections through this. And although they don't look like major corrections, this correction here was a 22% correction. This correction that happened here was a 41% correction. And this right here is probably one of the only times that we've actually cut rates in the past that I've been able to identify that we haven't seen a market crash. However, there were 40% corrections and 20% corrections that actually occurred during this time period. So this is one of the only examples I've actually found where the market didn't crash during a rate cut. However, if we have a look back to the time just before that when we had another rate cut, although this was a much smaller rate cut, this was back in the 70s. And as you can see, rates were increased until August of 73. And then eventually, once they started cutting rates, they hiked them again. And then we've seen another cutting cycle. However, during this period from the initial rate cut, we did see a 43% correction in the stock market. And even if we have a look to the time before that, when you can see that rates were clearly cut during this period here, if we have a look right when these rate cuts started occurring, you can see there was a 34% correction that happened during this rate cut. We can just keep going back and having a look at all these examples of times they've cut rates here. Even these smaller cuts, when the Fed's fund rate was first actually invented, you can see that these two rate cuts that occurred right here back in the 60s and the 50s both led to pullbacks in the Dow Jones of almost 20%. And again, in this time down here when they cut rates of just over 20%. And then back here is when the Fed funds rate was actually created. So what we can see here is that during the entire time that we've had rates, essentially only once was it bullish for the market, and 1, 2, 3, 4, 5, 6, 7, and 8 times here did it actually lead to recessions, or at least massive corrections in the stock market. And if we actually have a look at where the stock market is sitting today, what you'll notice is that if we were to have one of those corrections, and let's say it is a 40% correction like we've seen in the past, that would bring the stock market from current price levels. A 40% correction would bring us past those pre-COVID levels, actually even lower, down to around 27,000 for the Dow Jones, which would be a massive crash from today's price. However, if we turn the Fed's fund rate off here and we actually have a look at where I think we are in the stock market, this reminds me a lot of the Roaring 20s. And what I want to show you in the second part of this video is why I don't think they're going to cut rates soon. And I think the next rate is actually going to come when the stock market is a lot higher. And we should see quite a bit of a rally from this level here before they actually end up cutting rates and sending us into a possible another recession. Now, my reasoning for this is that if we actually have a look back all the way to the 1920s, and we have a look at the Roaring 20s here, what you'll see is I've got some 5-wave Elliott structures here actually mapped out. Now, I want to delete all of these and actually show you guys how we came to these 5-wave structures. Now, what you can see here is that during the Roaring 20s, the first 5-wave structure we have mapped out is the initial move off the lows here, which then led to a 1, 2, 3, 4, and then an explosive 5th wave, which ended up giving us the top right in 1929. And as you can see, this is an explosive blow off top, and it gets quite parabolic here. There aren't many corrections along the way, and things really just do get quite steep as far as the price curve goes. What you normally find in a 5-wave move like this is that in the final 5th wave, there should be another very easy to identify 5-wave structure. Now, if we actually zoom in and just having a look at this initially, you can see that this is clearly the first wave, this is the 3rd, 4th, and this would be the 5th wave. And the reason this is how I believe the 5-wave structure goes is because what we can see during this period is just a period of high lows. And the first time we actually see lower lows is right in here, where I believe we get our 3rd wave. And now another thing that you want to see in this final 5-wave move is actually another final finishing 5-wave structure. And if we have a look at the low that was set down here in our 4th wave, we can see that this is the 1st wave, this is the 2nd wave, this is our 3rd wave, 4th wave, and our final 5th wave. And I'll make that blue so it's easier to see. What you can see is that we have a 5-wave structure all the way from the start of this market cycle, another 5-wave structure in the final 5th wave, and then another 5-wave structure in that final 5th wave. Now, the reason all of this is relevant and the reason Elliott wave works is because it is great at actually identifying the top of market cycles. And a market cycle tends to last between 15 to 20 years on average. Now, if we actually go back all the way to today's price chart and have a look at how things are playing out, you can see that this is what the Dow Jones currently looks like today. And if we're going to draw out our similar 5-wave structures here, I think the most fair place to start is right down here at this level and this consolidation region, which, if we actually have a look, is February of 2009, and we all know what happened in 2008, the GFC. So we're going to start our 5-wave structure from here, and I think the first wave actually goes up right to pre-COVID. Then the COVID crash is the dump in our 2nd wave. Our 3rd wave brings us right to the top, and our 4th wave is actually the Russia-Ukraine war. And right now what we're putting in is, I believe, the final 5th wave. I don't believe that the tariff scare counts as a wave in this first wave count, and that what I think we are putting in is that final 5th wave in the stock market here. So what we want to have a look for is, in this final 5th wave, can we identify a 5-wave move? So what we're going to do is actually just bring this down to the 3-day time frame so we can get a little bit more data here. Now, the way I'm looking at this so far is that the first wave here coming out of the Russia-Ukraine war and our first pullback that we had in this zone up until the start of Trump's presidency, then we had the tariff drama, and now I think we are actually putting in the final 5th wave in this move. And that in this final 5th wave, what we'll be looking for is a final 1, 2, 3, 4, 5. And I'll make this one orange so we can see it easier. And this is what I think we're setting up for, the final blow-off stage, similar to the way things actually played out in the Roaring 20s. And so far in this move, all we've seen, in my opinion, is just the first wave. And that I think what we will be looking for in this final move is a 5-wave structure that plays out similar to the way things actually worked out in the 1920s. Now, what I have here on the right is actually a fractal pulled from those final 5-wave structures that played out in the 1920s. And scarily enough, if you actually overlay that to the way price is playing out right now, it could start to look eerily similar. And that if we do continue to actually see the Dow Jones play out something similar like this, which is how things played out in the 1920s again, it wouldn't surprise me to see that final 5-wave structure actually appear right here and finish off the final wave in the stock market. Now, this is just a fractal, so I don't think price is going to play out similar to the way things played out in the 1920s here. However, what I will be looking for is a 5-wave move to actually finish off this parabolic push we've actually had in the Dow Jones over the course of the last 16 to 17 years. Which, if we combine that with the fact that they haven't yet again cut the funds rate here and things have remained paused, if they are to drag that pause out leading into 2026, right as we start to see a parabolic ending phase come in here for the Dow Jones Industrial Average, I think there's just too many confluence factors lining up pointing to some kind of serious recession or serious market crash that could occur within the next year. And that what you want to see in a final wave for the stock market is actually smaller markets pumping and going into similar blow-off top phases like we think Bitcoin is actually going into here. And that 150,000 top that we currently have set for Bitcoin doesn't seem too unrealistic if we're expecting the stock market to push another 15 to 20% higher and actually set that final 5th wave, all while at the same time having these final parabolic endings for Bitcoin and the stock market to actually see the Bitcoin dominance break down in this time and see even smaller markets like the altcoin market here actually break out from these consolidation structures and ranges that they've been in and go in and put in a parabolic ending of their own, which is exactly what we've been talking about here for not only the altcoin market, but coins like XRP. So guys, I hope I've given you a bit of perspective here on what I'm seeing actually play out for the stock market and wider markets as a whole. And that the reason we're seeing what we're seeing in crypto is not just because crypto is rallying and it's time for crypto to pump. It's because what's actually happening here is a final move in the stock market, similar to the way things actually played out during the Roaring 20s. And that if on Wednesday we continue to see the Fed actually pause rates and continue to pause rates going into 2026, that eventually when they start cutting them, we know what to expect here on the channel, and that the only time the money printer actually gets turned on is once the rates have actually bottomed. As you can see, every time the rates bottom, money starts to get printed and injected back into the economy because the debt and the interest rate that the US government has to repay on those loans is actually all the way down at these 0% levels. This is why they print during times like this. This is why they stimulate the economy, because the interest on the debt they owe is much lower compared to where it's at right now, 4 or 5%. And when we're talking trillions of dollars of debt, a couple percent is a big deal. So guys, a bit of a different video today. I try my best not to touch on crypto, but I think it's relevant because everything that's happening now and what we're seeing in crypto is all based around this. And if you can understand larger macro conditions and what's actually going on, a lot of the Bitcoin stuff, a lot of the crypto stuff becomes a lot more simple. And that what we're seeing now isn't some crypto only, Bitcoin only rally. It's all tied into this. And it has been since crypto has been invented. Even if you have a look at the last bull run for crypto, boom, right there, 2020, that's when the bull run started. The one before that, 2017, boom, right there for the stock market. Look at the rally we had. The one before that, 2013, boom, right there for the stock market. Look at the rally we ended up having before stalling out. And then if you look all the way back to Bitcoin's inception from the GFC, you'll notice that the stock market has only just gone up. So how do you guys think Bitcoin's going to react if we actually go into some kind of recession like we've seen back in the 1920s, which is a huge sell-off for the Dow Jones? But this is something to touch on in further videos when we actually start to see these tops come in and we can start to talk about price estimates for Bitcoin and how the potential of actually seeing a 10 to 20,000 Bitcoin someday in the future isn't that unrealistic. And that during a move like this, crypto as an asset class could get absolutely demolished. But again, this is all months and months away, so nothing to stress about yet. Just keeping this in the back of our mind. This is how things could play out leading into and during 2026. So guys, I hope you learned something new. If you're new to the channel, feel free to subscribe and leave a like. It helps a lot. If you have any questions about this, crypto, macro cycles, anything, drop it down below in the comment section. And I'll see you guys tomorrow in the next video.